Greetings. Today is Friday, November 1st, 2024, and the election season is thankfully almost over. This is our monthly market monologue where we're going to talk about the markets and review October, as well as look at presidential election years. So let's dive in. We usually talk about economics in a separate video, but given the presidential election year and the update to inflation, I thought it would be worthy to start here. So on the screen, we have CPI. CPI is the Consumer Price Index, and that is the measure of inflation that most of you are familiar with. Technically, yesterday we got an update on PCE, which is a different measure of inflation, and that's the measure that the Federal Reserve officials prefer. I'm showing you CPI because you're used to it. And I'm talking about this first because, thankfully, the presidential election is almost over. Now, both candidates for the White House have talked about lowering grocery prices. So I wanted to show you something and explain something if you're not aware of this. So on the screen, we have CPI, and you can see, yes, inflation was really, really bad, but we have been seeing inflation come down. Now, this is technically disinflation. Disinflation is a slowing of the rate of inflation. That's what we've been seeing. But both candidates for White House have been talking about lowering grocery prices. We are not going to see grocery prices lowered unless we see deflation. What's deflation? Deflation is this over here. If you remember 2008 and 2009, we did have deflation. Now, I, for one, don't want to go back to a period like that. That was a pretty ugly environment. So my point here is just be careful what you wish for. Of course, we want prices to go down, but deflation is sometimes even more damaging to an economy than inflation is. So it's good that we are seeing disinflation. I'm not so sure we want to get all the way into deflation. Now on the screen, we have in blue, we have the 10-year yield. The green is the federal funds rate. And I'm covering these two economic points, both the inflation as this. I'm covering these points early in the video because if you don't make it through the entire video, these are the number one and number two things that I really want you to understand. Hopefully you'll watch the entire video. Hopefully you'll subscribe if you haven't already, and hopefully you'll share the video with other friends, family, or colleagues that might find value in working with us and at a minimum find value in these videos. That said, what we've been talking about for a number of years is the correlation between the 10-year yield and the federal funds rate. This is one of the reasons why many people suggest that we don't really need the Federal Reserve to set interest rate policy. We can just use whatever the 10-year yield is. I just want to highlight the correlation, and we're going to come back to that in just a second. So let's just focus on the 10-year yield. What have we seen over the course of the last 40 years or so? We've seen a negative trend in yields. Remember, negative trend in yields means a positive trend in bond prices. Recently, on the right-hand side of the chart, you can see that the bond yields, the 10-year yield, has finally broken this down trend line. And we've had rising yields and a rising interest rate environment. That's not news to any of you. And let's zoom into what's happening currently. So again, you see that trend line is still on the screen, but let's add another trend line to the top of the most recent history. And you can see the yields have come down, we've come up, we've come down. So where are we at right now is at the top of that trend line. And what's going to happen over these next weeks is really important because is the 10-year yield going to break through that trend line and we're going to have another short-term trend change? Or is this trend of downward sloping yields going to continue? Here's the point. Let's add the federal funds rate back into this, and here's the point. Many have been suggesting or anticipating that the Federal Reserve is going to cut interest rates. At the beginning of the year, and I think we talked about this back in the January monologue, some pundits were suggesting, or the market participants were suggesting, that we might get 6 interest rate cuts this year. I think I'm on record of saying I didn't think that was going to happen. So far, we've only gotten 1 cut. But what are we seeing right now? Well, first of all, we're seeing the trend in bond yields rising back up to this downtrend like we just showed, but it's also headed back to where the federal funds rate is actually currently set. So what's going to happen? Well, short answer is I don't know, but it's going to be interesting to watch because what does it mean? If the yields continue to rise through that downtrend line, that would suggest to me that yields are tending to head higher, which would imply the Federal Reserve is unlikely to cut interest rates again. And I would suggest that is some of the reason why we're experiencing some volatility, is because the yields are suggesting that we may not be getting more interest rate cuts after all. Okay, the next thing that we want to walk through are the seasonality charts. The seasonality charts, remember, are just breaking performance down on a monthly basis. And so I'm going to show you what I showed in the October video as well as the update. So on the screen right now, we have the slide that I showed you in the October monthly market monologue, and we were highlighting the fact that September 2024 was well above average. And we were going into this seasonally strong period of the year where October, November, December, and then January are historically strong periods. So that was encouraging to see that September was as strong as it was. What happened in October? We can see that October in the S&P 500 was far worse than the historical average. What about the small cap index? This is the S&P 600. September was well above average. October, well below average. You see a theme. NASDAQ in September, well above average, and then in October, well below average. And this is going into the seasonally strong period of the year. And I would contend a couple of things are likely happening. First of all, we had such a strong September that a pause in the market is very reasonable to expect. And that's what we're seeing. And I'll show you a chart on that in just a minute. But the other thing that I think is happening is, first of all, the market is reacting to the inflation reports and the yields, what's happening to the yields. That is suggesting something economically, which we've already talked about, and I might circle back to that in next week's video. But I think the market is also waiting, just like everybody. We are all waiting for this presidential election to be over. So I think that is some of what we're experiencing. The fact that this recent drawdown so far is only about 3%. You are never going to get into the stock market at the bottom and out of the stock market at the top. If you're going to be involved in the stock market at all, and this is true of the bond market as well, if you're going to have any money in the stock or the bond market, you have to be able to tolerate some of the normal market actions. I would contend that a 3% drawdown in the broad index is very, very normal. Now, you can see that I've drawn a couple of blue rectangles on the screen. These would be zones that I'm particularly watching. This is a high from July, and then that we reached about that same level in September and August, and we couldn't break through that, fell down, and then we finally broke through this, and then we came back and we tested this. This level is what's referred to as a resistance level. And by classical technical analysis definition, that which was formerly resistance becomes support. And so this area acted as a level of resistance here, and then it acted as resistance there. This is actually a stronger level of resistance given how many times the index touched that level, and then we finally broke through. But resistance has a tendency to become support once it's been broken. So it broke, and then we had a little bit of correction. Look what happened. We tested that area successfully and the market rallied. Well, what's happening recently? Well, I wouldn't be surprised if this level gets tested again. I would contend that is always uncomfortable, but if it tests this level and assuming that test gets passed, if we've passed that test and the market rallies off of that, long term, that is actually a very good sign. Now, what happens if this level fails? I would argue this is the next logical spot for the market to serve as resistance for the same reason. We served support here and here. The support area failed here, but it did serve as support here and here. So this would be the next level. Now, it's been about a year since the S&P 500 has experienced a 10% pullback. By historical standards, we see a couple of 5% pullbacks each year, and usually about 10% pullback. That's very, very normal. Well, where is the 10% pullback? It actually would be below this level. So where is the stock market going to stop falling and where is it going to recover? I obviously do not know that definitively, but just like everything else that we do, we're going to follow our rules and we will invest accordingly. Let's wrap up by taking a look at the presidential election years. On the screen is another seasonality chart this year. This time I've broken it down by year. And so you can see since the S&P 500 was created, there's really only 3 years that were negative. 2000 and 2008 being the most notable, but 1960 was also a negative year. We should look at 1976 because I'm going to talk about this right here, 1977, in just a second. When we change that data into a line chart, here's that same data, but a line chart. The red line represents 2024. And so it appears that 2024 so far has been the strongest, barely, but the strongest presidential election year on record since the S&P 500 was created. So what happens after the presidential election? So this is a line chart, again, same data, but now I'm saying starting on November 1st, what happens over the next 12 months. And you can see an upward bias. If you want to do the math, I've done the math for you on the bottom left. But if we take a look, you see 2000 and 2008. Those are those 2 election years. And the only other significant negative, I would argue, is 1976. So the year after, I think was that when Carter was elected? The year after Carter was elected, that 12-month term, so basically November 1 of 76 to October 31 of 77, that was a negative about 4%. And where does that fall? That's what this looks like in terms of where that's December 1976, right after President Carter was elected. And we had a bit of a pullback going into 1977. Keep in mind where that falls in the greater scheme of things. This is that secular bear market of 65 through 79 that we've talked about ad nauseum. This is what we're cautious about. This is one of the reasons why we remain on guard, because if we're going to go through an environment like that, again, and I'm not predicting that we are, but if we're going to go through an environment like that, we need to be prepared. So anyway, that's a little bit longer than I wanted to do for today, but hopefully you find value in these videos. If you do, please make sure you hit the like button on the YouTube channel. Subscribe if you haven't already. And by all means, if there's anything that we can do for you, your family, your friends, your colleagues, etc., by all means, feel free to reach out to us. We would be more than happy to see if we can't be of service to them. Until next time, thanks for watching, and we'll talk to you soon.